All right, let's get right into it. Have you ever seen something in the market that just doesn't add up? Well, that's exactly what happened with the research firm Gartner after their earnings call on February 3rd. It's a classic Wall Street puzzle. The company posts good-looking numbers, but the stock gets absolutely hammered. We're going to unpack exactly what went down and, more importantly, why.
So check this out. On one side of the coin, you've got a killer fourth quarter earnings report, a solid beat. Normally, that's champagne popping time, right? But then look at the other side. The stock didn't just dip, it completely nosedived. We're talking a 30% drop. So, what gives? How can those two things even exist in the same universe?
And that's the big mystery we're solving today. What in the world did management say on that call that made investors hit the panic button and just ignore all the good news? Because clearly something spooked them. And it wasn't the headline numbers everyone saw at first glance.
Okay, so to really get what happened, we've got to play detective. And first, we need to examine the scene, which in this case looks surprisingly clean. I mean, on the surface, everything about Gartner's Q4 financials looked pretty darn good.
Exhibit A, earnings per share. The company posted an adjusted EPS of $3.94. Now, that's not just a beat, it's a big beat, a full 43 cents higher than what Wall Street was expecting. So, that's a huge check mark in the win column. All right, next up, get this. They spent $2 billion buying back their own stock in 2025. Billion with a B. That took about 8% of their shares right off the market. Now, why does that matter? Well, it's basically management screaming from the rooftops, "We think our stock is a fantastic deal." It's a massive sign of confidence. So, another point for the good news column, right?
And the positive story just keeps on going. Their adjusted EBITDA was up 5%. Full-year free cash flow, that's the actual cash they're putting in the bank, was a super healthy $1.2 billion. And their total contract value, which is basically their pipeline of future guaranteed money, was sitting pretty at $5.2 billion. You look at all this and you think, man, this was a great quarter.
But, and this is a huge but, here's where the record scratches and the whole mood changes. See, Wall Street has a really short memory. It doesn't care that much about what you did yesterday. It's obsessed with what you're going to do tomorrow. And the story Gartner told about tomorrow, well, that changed everything.
And you don't have to take my word for it. This is straight from the CEO himself, Gene Hall. He came right out and said it. Clients are basically slamming on the brakes. They're pushing off projects, delaying decisions, creating, in his own words, a much tougher selling environment. Boom. There it is, the first giant waving red flag for investors.
So what does a tougher environment actually look like in spreadsheet terms? Well, here you go. Just look at the guidance for next year compared to the year they just finished. Revenue, guided down. Adjusted EPS, down. Adjusted EBITDA, you guessed it, down. For anyone betting on growth, this was like a punch to the gut. The train wasn't just slowing down, it looked like it was going in reverse.
And here's the number that really sent a chill down the market's spine. 23.5%. This was management's new baseline for profitability. Now, they tried to frame it as a reset, a new solid foundation. But investors? Oh, they heard something completely different. They heard, we have no idea what's coming, and things are going to be a lot less profitable. The future suddenly got a whole lot murkier.
So you've got a tough road ahead, and profits are expected to shrink. What do you think happened next? Yeah, investors didn't exactly stick around to see how the movie ends. They bolted for the exits, and boy, did they do it fast.
And just to put into perspective how brutal this sell-off was, just look at this chart. Over the past year, Gartner's stock has been crushed, down over 70%. At the same time, the broader tech sector was up almost 24%. It's not just that Gartner had a bad year, it's that they were sinking while almost everyone else was swimming. That is a brutal comparison.
And that right there is the answer to our puzzle. The good news from Q4? It didn't matter. It was completely wiped out by the bad news about the future. For Wall Street, a scary story about tomorrow will always beat a happy story about yesterday. It's all about what's next.
Okay, so the damage is done. The stock has been hammered. The big question now is, what's next? Where could this thing possibly go from here? We need to figure out what to watch for to see if a comeback is even in the cards.
All right, so here's our watch list. This is what you've got to keep a close eye on. Number 1, that contract value number. Does it start growing again? That's huge. 2, they've got this new AI tool called AskGartner. Does it actually help them keep customers, or is it just hype? 3, they're selling off a piece of their business. What are they going to do with all that cash? And 4, and this is maybe the most important one, can they hold the line on that new 23.5% profit margin? Can they prove it's a floor, not a new ceiling?
So when you put it all together, our call is an underperform rating. Look, you've got a massive guidance cut, management basically telling you it's going to be tough sledding, and a market that has completely lost faith. That is a powerful headwind to fight against. Until we see some real concrete proof that things are turning around on those catalysts we just talked about, it's just really hard to see this stock keeping up with the broader market.
And of course, a final and very important note. This is not financial advice. This analysis is for informational purposes only. You should always do your own research.